The traditional lending market is built on credit assessment, relationship banking, and trust in counterparties. DeFi lending protocols replace all of this with mathematics and collateral. Aave, Compound, and similar protocols have collectively processed trillions in loan volume without a single credit officer, underwriter, or loan agreement. Instead, they rely on overcollateralization, automated liquidation, and transparent interest rate curves to maintain solvency. For institutional participants, DeFi lending offers two distinct opportunities. As a lender, depositing assets into lending protocols generates variable interest income sourced from borrower demand, with rates that are publicly visible and algorithmically determined. As a borrower, institutions can access instant liquidity against crypto collateral without selling underlying positions, useful for tax optimization, leverage strategies, or bridging liquidity gaps. The mechanics, risks, and opportunity set are materially different from any traditional lending product. This analysis provides the institutional framework for evaluating DeFi lending as both a yield source and a borrowing facility. The DeFi lending lifecycle is elegant in its simplicity and ruthless in its enforcement. Unlike traditional secured lending, there is no negotiation, no cure period, and no relationship management when a position approaches liquidation. The smart contract executes the liquidation automatically the moment the collateralization ratio breaches the threshold. This mechanical efficiency is both the system's greatest strength and a key operational risk for institutional borrowers. A crypto market volatility event that rapidly depresses collateral values can trigger cascading liquidations faster than any operations team can respond. Institutions using DeFi lending for leverage strategies must maintain substantial collateral buffers above the liquidation threshold and have automated monitoring systems capable of triggering collateral top-ups before the liquidation level is reached. The interest rate model is fully transparent and predictable. Every major lending protocol publishes its interest rate curve, showing exactly what borrowing rates will be at each level of pool utilization. This transparency, unprecedented in traditional lending, allows institutions to model their borrowing costs with precision and arbitrage rate differentials across protocols. The yield dynamics of DeFi lending are directly competitive with traditional fixed income in certain rate environments and dramatically superior in others. During the 2020 to 2021 period of near-zero interest rates, DeFi stablecoin yields of 8 to 12% attracted enormous institutional attention as a source of USD-denominated yield when traditional alternatives offered essentially nothing. As the Federal Reserve raised rates from 2022 onward, T-bill yields caught up and eventually exceeded low-risk DeFi yields, reducing the relative attractiveness of DeFi for conservative institutional lenders. This rate sensitivity is a structural feature of DeFi lending markets. Borrower demand for stablecoin loans is partly driven by the cost of capital in traditional markets, creating a natural arbitrage that keeps DeFi rates roughly correlated with traditional credit markets over medium-term horizons. For institutions evaluating DeFi lending as a yield source, the risk-adjusted comparison must account for smart contract risk, potential protocol insolvency from bad debt, and the absence of deposit insurance. The appropriate risk premium above T-bill yields for DeFi lending exposure is a legitimate debate, but most institutional risk frameworks apply a minimum premium of 200 to 400 basis points to compensate for these incremental risks. Flash loans are one of the most intellectually fascinating primitives in DeFi and one of the most misunderstood by traditional financial professionals. The concept is uniquely possible on blockchains because transaction execution is atomic. Within a single blockchain transaction, a complex sequence of actions either all succeed or all revert with no net state change. This atomicity enables flash loans. A protocol can lend arbitrarily large amounts with no collateral because the loan must be repaid within the same transaction. If the borrower fails to repay, the entire transaction reverts as if it never happened. The risk to the lender is precisely zero, because the alternative is not a bad loan but a transaction that never occurred. For institutional trading desks, flash loans enable sophisticated arbitrage and collateral management operations that would otherwise require large capital commitments. For protocol security teams, flash loans represent a significant attack amplification vector. Several high-profile DeFi exploits have used flash loans to temporarily inflate the attacker's capital by hundreds of millions of dollars, enabling oracle manipulation attacks that would otherwise be economically infeasible. DeFi lending risk is multi-layered and requires institutional-grade due diligence before capital deployment. The smart contract risk of established protocols like Aave and Compound has been substantially reduced through multiple audits, bug bounty programs, and years of battle testing with live capital. But reduced risk is not zero risk. and the position limits applied to DeFi lending should reflect the remaining smart contract tail risk. Governance attack risk materialized dramatically in the 2022 Mango Markets incident, where an attacker accumulated Mango governance tokens, passed a governance proposal to award themselves protocol treasury funds, and extracted approximately 17 million before the attack was recognized and reversed through subsequent governance action. This demonstrated that governance mechanisms, intended as a decentralization feature, can become an attack surface for well-capitalized adversaries. Liquidity risk in DeFi lending is operationally distinct from traditional money market liquidity risk. When protocol utilization rates are very high, the algorithmic interest rate model prices borrowing rates extremely high to incentivize repayment and disincentivize new borrowing. In extreme cases, withdrawal queues can form that make immediate exits economically painful. Institutions must maintain sufficient liquidity buffers outside DeFi protocols to avoid forced selling at unfavorable exit prices. The DeFi lending market has consolidated significantly after the 2022 to 2023 bear market, and a series of protocol exploits eliminated several earlier competitors. Aave has emerged as the clear institutional standard. Multi-chain deployment, institutional interface products, extensive auditing history, and a governance structure that has demonstrated resilience to attack attempts. Morpho represents an interesting institutional development, a meta protocol that routes deposits into Aave and Compound while providing a separate peer-to-peer matching layer that improves capital efficiency and yield for larger participants. Morpho has attracted significant institutional attention precisely because it leverages the security track record of established protocols while improving the economics for large depositors. MakerDAO, now rebranded as Sky, occupies a distinct position as the issuer of DAI, the largest decentralized stablecoin, and is one of the largest holders of tokenized real-world assets. Its lending infrastructure now blends traditional finance instruments, US Treasury tokens, real estate debt, with crypto-native collateral, making it an interesting case study in the convergence of TradFi and DeFi. DeFi lending represents one of the most mature and institutionally accessible segments of the decentralized finance ecosystem. The combination of transparent mechanics, public track records, and multi-year operational history makes Aave and Compound more analytically tractable than most DeFi protocols, enabling institutional investors to apply rigorous risk frameworks rather than relying solely on qualitative trust. The yield opportunity in DeFi lending is real and durable. The protocols earn genuine economic rent from borrowers willing to pay premium rates for instant, permissionless access to capital. That economic rent flows to depositors who provide the capital, creating a sustainable yield model that does not depend on token inflation or unsustainable incentive structures. For institutions establishing their first DeFi positions, lending protocols are the natural entry point. The mechanics are understandable, the risks are quantifiable, the yields are competitive with traditional alternatives, and the operational infrastructure for managing DeFi lending exposure is more mature than virtually any other DeFi segment. Building competency here creates the foundation for expanding into more complex DeFi strategies as the institution develops greater operational and analytical confidence.